The IRS has exactly 10 years to collect what you owe. Most people assume the number is 2 or 3. The actual number is 10, written into 26 U.S. Code, Section 6502, 10 years after assessment. Here is what that does not mean. It does not mean the IRS waits. It means the IRS has a 10-year window to levy your wages, seize your bank account, and file a lien on your house, starting not when you filed your return, but when the IRS formally recorded the debt. That date is the assessment date. The clock starts there. And here is what almost nobody knows. That window is not fixed. Every time you act to resolve the debt, file for bankruptcy, submit an offer in compromise, request a payment plan, appeal a collection notice, the clock pauses. When it restarts, the IRS gets that time back plus extensions. The actions you take to resolve the debt are the same actions that extend the IRS's right to collect it. That is the mechanism this video covers. The 10-year clock does not start when you file your return. It starts when the IRS assesses the tax. And those two dates are not the same thing. Assessment is the official act by which the IRS records the liability in its system. For a return you filed on time, assessment usually happens within a few weeks of filing. But usually is not always, and the gap matters. 26 U.S.C. Section 6502 states the rule plainly. The IRS may collect by levy or court proceeding within 10 years after the assessment of the tax. Before 1998, the window was 6 years. Congress extended it by 4 years. The IRS uses every day of it. What the assessment date establishes is the Collection Statute Expiration Date, the CSED. That is the date on which the IRS's legal right to collect the specific debt expires. Each tax period, each assessment, carries its own CSED. If you owe for 2019 and 2020 separately, you have 2 clocks running. They do not share a deadline. The IRS tracks the CSED in its internal records. You can request your own CSED by calling the IRS directly or by submitting Form 4506-T. The date is not printed on any notice the IRS sends you. Most people do not know it exists until a tax professional tells them, usually after they have already done something that moved it. And here is what the IRS does not explain in any notice. The CSED is not a passive countdown working in your favor. It is a managed deadline, one the system can extend through specific legal mechanisms that look, from the outside, like normal steps toward resolution. Not everyone's 10-year clock starts on the same day as their filing date. For most people who file on time and owe, assessment follows filing within weeks. But there are situations where the assessment date comes later, sometimes years later, and each one creates a separate, independent CSED. A late filing is the most common. If you filed your 2018 return in 2021, the 10-year clock did not start in 2018. It started when the IRS processed your 2021 filing and assessed the liability. Your CSED for that year runs to 2031, not 2028. 3 years of delay on your end added 3 years to the IRS's collection window. If you never filed, the IRS files for you. Under IRC Section 6020B, the IRS can create a substitute for return using W-2s, 1099s, and employer records, and assess tax directly from it. That assessment creates its own CSED, starting from the date the IRS filed the substitute, not the year you earned the income. The IRS does not notify you when this happens. You would need to request your transcript to find out. Most people only discover a substitute for return exists when collection begins. An audit compounds the picture. If the IRS audits your return and finds additional tax owed, It issues a notice of deficiency. Once you agree, or the time to contest expires, the IRS assesses the additional amount. That assessment has its own CSED, running 10 years from the audit date, not from the original filing. 3 separate clocks, each running independently, and none of them on the schedule you assumed. And the IRS's tools for collection are not limited to waiting. Within the 10-year window, the IRS is not sitting still. Collection is an active process, a sequence of specific legal tools the IRS deploys in order, and then in combination to recover what you owe. Understanding what those tools are is not abstract. They touch your paycheck, your bank account, and the title to your property. The federal tax lien comes first. Under IRC Section 6321, a lien arises automatically the moment the IRS assesses a tax and you fail to pay after demand. It attaches to everything you own: real estate, vehicles, financial accounts, business assets. The IRS does not need a court order. It files a public notice of federal tax lien with the county recorder, which shows up on title searches, damages your credit, and can block a sale or refinance of your home until the debt is resolved. The lien is the claim. The levy is the collection. A levy is an actual seizure of property. The IRS can reach your wages directly, your employer required by law to comply. It can sweep your bank account in a single transaction. It can seize your car, your business equipment, even your retirement account in some cases. A wage levy is continuous. It keeps taking a portion of every paycheck until the debt is paid or the IRS releases it. Both tools can be deployed at any point inside the 10-year window. There is no minimum waiting period. The IRS issues a final notice. You have 30 days to request a hearing, and if you do nothing, collection begins. Think about what that means for your account. The lien is already there from the moment of assessment. The levy is the follow-through. And the question is not whether the IRS will use these tools. It is when. The 10-year clock is not a straight line. It can stop. In tax law, the legal term for this is tolling, a suspension of the running period during which the IRS's right to collect is temporarily frozen, and the clock does not move. But when the suspension ends, the IRS gets all of that frozen time back. The CSED extends by exactly the number of days the clock was paused, plus any additional period the specific tolling event adds under the statute. The IRS is required to track tolling events. Under IRS Internal Revenue Manual 5.1.19, revenue officers must identify the current CSED before initiating collection action. They recalculate it accounting for every suspension that has occurred. You may believe your debt expires in 2026. The IRS's calculation may show 2029. Both numbers come from the same original assessment. The difference is what happened in between. There are 4 main tolling events: bankruptcy, an offer and compromise, an installment agreement request, a collection due process hearing. Each one is a legitimate path the IRS itself makes available for resolving a tax debt. Each one, by design, suspends the clock while it is pending. The law that creates the resolution option is the same law that pauses the countdown. That is not a coincidence. It is a feature of how the collection system was built. And the next 3 blocks cover each tolling event in detail, starting with the one that surprises most people who use it. Bankruptcy is designed to give people a fresh start. For tax debt, it does something more specific. It buys time. And the time it buys does not disappear when the bankruptcy ends. It gets added back to the IRS's collection window. When you file for bankruptcy, an automatic stay kicks in immediately. The IRS cannot levy your wages, drain your account, or enforce its lien while the case is active. The CSED stops running from the day you file. If you are in bankruptcy for 18 months, the IRS gets those 18 months added back. But the clock does not simply resume where it left off. Under IRC Section 6503H, the CSED extends by the full duration of the bankruptcy case, plus an additional 6 months after the case concludes. That 6-month extension exists because Congress recognized that the IRS needs time to get its systems back in order after a bankruptcy stay lifts. The practical effect: a 2-year bankruptcy case adds 2 years and 6 months to your CSED. Not 2 years, 2.5. Some income tax debt can be discharged in bankruptcy, but only if it meets a specific set of criteria under the Bankruptcy Code, including a rule that the tax return must have been filed more than 2 years before the bankruptcy filing, and the tax must have been assessed more than 240 days before the filing. Those conditions require careful timing. Most people who file bankruptcy primarily to deal with tax debt do not qualify for discharge. They get the stay, they get the extension, and they emerge from bankruptcy with the IRS's clock reset and the debt still intact. And here is what happens when you try a different approach to resolution. An offer in compromise is the IRS program that lets you settle a tax debt for less than the full amount owed, if you can demonstrate that the full amount is uncollectible given your assets and income. It is a legitimate resolution tool. It is also a mechanism that can extend the IRS's collection window by a year or more, entirely through your own choices. The moment the IRS receives your OIC application, the CSED stops. It stays stopped from the date the IRS receives the offer until the offer is accepted, rejected, withdrawn, or returned as incomplete. Then, per the Taxpayer Advocate Service's CSED guidance, the clock stays paused for an additional 30 days after rejection, so the IRS cannot immediately levy while you are deciding what to do next. If you appeal the rejection, the CSED remains suspended through the entire appeal process, including any appeal to the IRS Office of Appeals. A typical OIC timeline runs 12 to 18 months from submission to determination. An appeal can add another 6 to 12 months. If you are in year 8 of your CSED when you submit, a point at which the 10-year window appears close to expiring, the OIC process alone could push your actual expiration date to year 11 or 12. The IRS emerges from the process with a fresh window to collect whatever portion of the debt it did not accept in the offer. That does not mean the OIC is a bad strategy. For qualifying taxpayers, settling for less than full liability is a genuine benefit. But the decision to file an offer is also a decision to extend the collection statute. Both things are true at the same time. If you want to know what your CSED is right now and whether your debt qualifies for an OIC, subscribe. The next video covers both. And OICs are not the only resolution tool that pauses the clock. An installment agreement lets you pay your tax debt over time in monthly payments. The IRS approves them routinely. What the IRS does not explain when it sets one up is what happens to the CSED while your request is being processed. The clock pauses from the date the IRS receives your installment agreement request until the request is either approved, rejected, or withdrawn. Processing time for an IA request varies. A simple case might take a few weeks. A complex case involving large balances or multiple years can sit in the IRS queue for months. During all of that time, the CSED is suspended. The IRS's collection window is growing while your application is under review without any action on your part. Once the installment agreement is active and approved, the CSED resumes running normally. which is different from bankruptcy and OICs where the clock stops for the full duration. But the pending period can still add weeks or months to the back end of your collection statute. IRS Internal Revenue Manual 5.14.2 addresses a specific subtype called a Partial Payment Installment Agreement. In a PPIA, the monthly payment is set lower than what would be required to pay off the full balance before the CSED expires. The IRS enters this agreement knowing it will collect less than the full amount, not as a concession, but as a structured collection plan designed to extract whatever is recoverable before the clock runs out. The IRS uses the CSED as a planning tool. Your payment schedule is built around it. The fourth tolling event is the one that most people use by accident, triggered by a legal right most taxpayers don't know they have. When the IRS issues a final notice of intent to levy, the formal warning that collection is about to begin, you have 30 days to request a collection due process hearing. The CDP hearing is a legal right Congress established in 1998. It gives you the opportunity to challenge the collection action before an independent IRS officer and, if you lose there, to appeal to the U.S. tax court. The moment the IRS receives your CDP hearing request, the CSED stops. It remains suspended for the entire duration of the hearing process. From the date of the IRS's receipt of your request through the hearing determination, any appeal to IRS Office of Appeals, and any petition to the U.S. tax court. A case that goes all the way to tax court can take a year to 18 months. The CSED does not move during any of that time. That is not a bug in the process. The law that created the CDP hearing also created the suspension. The right to contest collection and the extension of the collection window are the same provision. IRC Section 6330E1 states explicitly that the levy is prohibited during the hearing period, and the CSED is tolled for the same period. Here is what most people do not understand about how that plays out in practice. A taxpayer who receives a levy notice in year 9 of their CSED requests a CDP hearing and takes the case through tax court, emerges from that process with the IRS's clock extended well past the original 10-year mark. The legal challenge that was supposed to protect them from the levy bought the IRS an extra year or more of collection authority. The IRS knows this. It factors it into its collection timeline. The IRS does not treat the final years of a CSED the way a creditor who has given up treats a debt. It treats them as a deadline. And as that deadline approaches, the IRS's behavior changes in a specific, documented way. IRS Internal Revenue Manual 5.1.19 requires that revenue officers identify accounts approaching CSED expiration and take priority action before the window closes. The IRM sets internal thresholds. Accounts within 12 months of expiration are flagged. Accounts within 6 months move to mandatory review. The closer the CSED gets, the more urgently the IRS moves to levy whatever assets are accessible. This is the mechanism behind the pattern many people describe as the IRS suddenly gets aggressive after years of silence. The silence was not indifference.
It was the IRS managing its inventory of collection cases against available resources. When your CSED enters the priority window, your case moves up the queue. The practical consequence is that years of minimal contact from the IRS can create a false impression that the debt has aged out or been written off. It has not been written off. The IRS distinguishes between uncollectible status, a temporary suspension of active collection activity for hardship reasons, and actual CSED expiration. A debt in currently not collectible status is still alive. The clock is still running. And when the taxpayer's financial circumstances change, the IRS returns. That is not a metaphor. That is the actual statute and the actual collection procedure. And here is what finally happens when the clock does run out. When the CSED expires, the debt is legally uncollectible. The IRS cannot levy your wages. It cannot seize your bank account. It cannot proceed to court.
The liability does not disappear from your tax transcript. The IRS keeps a record, but the government's legal right to force collection ends at the moment of expiration. The lien follows a specific post-expiration procedure. Under IRC Section 6325A, the IRS is required to release a federal tax lien within 30 days of the CSED expiration if the debt has not been paid. The lien release is not automatic in practice. You may need to follow up and verify that it has been filed with the appropriate county recorder, but the legal obligation is there. What does not happen? The IRS does not notify you that the CSED has expired. There is no letter, no formal notice, no acknowledgement that the clock ran out. The expiration happens internally in the IRS's records, and it is your responsibility, or your tax professionals, to track it and act on the lien release. Think about that. The debt the IRS has been pursuing for 10 years becomes legally uncollectible on a specific calendar date, and the IRS sends no notification. Here is what most people miss about reaching that date. If any tolling events occurred, any bankruptcy, any OIC, any IA request, any CDP hearing, the date on which the CSED expired is not the date that was 10 years from assessment. It is later, sometimes years later. A taxpayer who believes they have outlasted the IRS may still be inside the collection window without knowing it. You cannot manage a deadline you cannot see, and that is exactly how the system is designed. The IRS has 10 years to collect what you owe, measured from the date of assessment, extended by every tolling event that occurs in between. The clock pauses for bankruptcy, for offers in compromise, for installment agreement requests, for collection due process hearings. It resumes with all of that time added back. The CSED expires on a date only the IRS tracks, and it sends you no notice when that date arrives. Benjamin Franklin printed the currency, but understood the mechanism underneath it. A debt that compounds, in time, in interest, in the government's window to collect it, does so through the small decisions you make along the way. The 10-year rule is the floor. What you do inside that window determines the ceiling. If any of this applies to your situation, the next video covers how to request your own CSED from the IRS and what to do with the number once you have it. Subscribe so you don't miss it.